We are going to look at 5 stocks today and use our very, very useful stock analyzer tool to determine what price to pay for them based on today's assumptions. They are Apple, Google, PayPal, eBay, and Alibaba. These are 5 stocks we've talked about a lot in the past. We're going to evaluate them. We're going to look at their 8 pillars and use them for stock analyzer tool. So if you're new to this channel, I'm Paul. I'm a value investor. The way I'm going to approach this is I'm going to look at each individual company and make what I perceive to be conservative assessments for the future, put them into our stock analyzer tool, and they'll spit out a number for me on what I should pay for the stock. This is all part of a process. Our 8 pillars are a great way to evaluate a company from a 500-foot view that tells a story and tells us what to research next. So if you belong to our software already and you're part of our community, come on here. Let's look at these things together. That way you get more and more acclimated to looking. So first company. I don't know if you've heard of it. It's a company called Apple. They sell fruit. So the 52-week low is 130 and the high is 183. They're currently selling at 165. Warren Buffett and Berkshire Hathaway have been buying Apple lately. Something tells me they're not buying it at 165 though. But let's go look at their 8 pillars real quick. So this is a very common theme we see. First and last pillars. These are our valuation metrics. The 5-year PE ratio and the 5-year price to free cash flow ratio are both X's. Now, does that mean you don't buy it? No. Hypothetically, if you knew that Apple was going to grow 20% a year for the next 10 years, of course you would buy Apple at these valuations because it's going to grow into that value just fine. But we don't know what they're going to be growing at. So we're going to make assessments of the future. But look at this return on invested capital, 33%. Our goal is to get 9%. They're buying back shares. Now, even though they're buying back shares, I'm not exactly enthused about that when I think the stock is overpriced, but we'll see if the stock is overpriced to see if that works. Low debt, increased cash flow, increased net income, increased revenue. All great things. So let's go to our stock analyzer tool. Now, if this is your first time watching this video, remember, we can do 1 to 20-year analysis. I tend to pick the 10-year analysis. And these are all of our assumptions we make about the future from a 500-foot view. So we have revenue growth, profit margin, free cash flow margin, and then the ending PE and ending price of free cash flow. What I mean by that is what PE and what price of free cash flow multiple will you apply to it at the end of 10 years? So in the last 10 years, Apple did 9.6% revenue growth, and it's actually gotten better as time has gone on. But again, my goal is to be conservative, and Apple's already a very, very large company. So my guess is they're probably not going to grow at the same pace they did in the last 10 years. Could I be wrong? Absolutely. If you told me 10 years ago they're going to grow 10% a year, I'd said, you're crazy. But that's my goal, is to be conservative, because if I make conservative assumptions if I make aggressive assumptions about 100 companies, I will probably be wrong on 80 or so of them. So my goal is to be conservative and wait for the price to get to the point where it makes sense to me. So I'm going to assume 3, 5, and 7% revenue growth. Now, profit margin, as you can see, 10 years, 23%, 5 years, 23%, fluke year. So I'm going to stay with 22, 23, and 24. Free cash flow, again, consistently around 25. So I'm going to go 24, 25, 26. Now, PE, guys, it's currently in the mid-20s. The bigger and bigger a company gets, the lower the PE should be. Now, also, if there's a very big moat, which I do believe Apple has, you should have a higher PE. So the question becomes, what's a reasonable PE for a company like this? Well, I'm going to sit there, and I usually do 13, 15, 17. But for Apple, I'm going to do 14, 16, and 18. And same with the free cash flow multiple. And for our final metric, desired annual return, I'm going to do 12.5%. And here's why. You can get 9 or 10% by investing in the market and in a long-term ETF. So give myself a little margin of safety and a reason to buy it. Now, before I hit the analyze button, we're going to do 4 more of these companies, right? So rewatch this if you want more of an explanation, because my next 4 videos, I'm not going to explain these assumptions more. I'm just going to go rattle through them. So please rewind this, the last minute, minute and a half, if you want to relook at the stock analyzer tool to understand my assumptions here. I'm just looking at the past and realizing that as the company grows, some of these are probably going to change. As more competition enters, some things will change. So hitting the analyze button. Apple's currently at 164, and here are our numbers. We have a low of in the 60s, a high in the low 100s, and middle range somewhere in the 80s. So if you have our software, the great thing you do is you can hit one of these check marks and add Apple to your watch list at that price. And it'll notify you on the website, over email, and on our application to do this. And if you like the software, it's less than a cup of coffee per day. Please check it out. We have thousands of people in our community talking every day. So if you just want to research a company, you go in there, you talk to people because people have done the research. There are thousands of people active every day here. Company number 2, the Google. So let's go back to our main page, type in Google, and let's check it out. Now, Google just split 20 for 1. They have a 52-week high of 150, a low of about 100, and they're currently at 116. Let's go to their 8 pillars, just like Apple. High PE and high price of free cash flow, but they're doing a lot of other things great. Now, they haven't bought back as many shares as Apple, which I'm actually happy about. This high PE and high price of free cash flow always makes me apprehensive. They also don't have as great an ROIC as Apple does. So let's go take a look at this company going forward. We're going to go to the stock analyzer tool. All right, again, big growth levels. It is Google. They own YouTube, which you're on right now. The 2 largest search engines in the world are google.com and youtube.com. So they're dominating that. They are the biggest online advertiser. So 6, 9, and 12%. Now for profit margin, it's pretty consistently in the last 5 and 10 years around 23%. So I'm going to do 22. I'm going to do 21.5, 22.5, and 23.5. Free cash flow margin, I'm actually going to do the exact same thing because it looks pretty consistent across the board there. Again, for PE, 14, 16, 18. They have such a great brand. I mean, they've been around for 20 some years, and Google just keeps getting better and better. And you go to Google they dominate search. I'm not saying it's never going to change, but boy, oh boy, can you imagine what it would take for a company to overtake Google in terms of search? So finally, our desired annual return, 12.5%. Hit the analyze button. Boom. All right. Well, it's a little bit better than Apple. We have a low of 65, a high of 130, and a middle of 92. So if you like all my assumptions above and you think they're spot on, then go do more research and make sure these assumptions are correct and you believe in them. But if you don't, be a little patient, add it to your watch list maybe, sit there and do more research and be ready because, guys, look at the stock price. It went from 150 to 100 very quickly. This thing could go from 116 to 90 very quickly as well. So be ready for that. Company number 3, PayPal. Now, PayPal, look at PayPal's stock price. This thing has fallen hard. It has a 52-week high of 295 and a low of 70, and it's currently at 95. It jumped up to 100 recently because they had great earnings last week, I believe, and we did a video on that. So anything to report here? Let's go to the 8 pillars. Look at this, guys. Something tells me we're going to have a lot of these. Again, first and last metric, just high valuations. Now, this low price of free cash flow ratio relative to earnings shows that they have more free cash flow than earnings, right? Because the lower the ratio, the more the free cash flow there is. So just remember that. So here, return on invested capital is great, revenue growth. Now, one thing that's interesting, their profit growth, net income growth, and free cash flow growth are very different. These should be equal over long periods of time. So I wonder why that is, but that's a question to ask. That's what I mean when I say the 8 pillars tells a story to understand. I am glad it's this way. Free cash flow is higher than net income growth, because if it was the other way around, I'd be like, what's going on there? That's always an indication when reported net income is greater than free cash flow. And the reason being is net income has a lot of alterations based on adjustments and based on IRS rules, accounting rules, etc. Free cash flow is harder to manipulate. So let's go to our stock analyzer tool. Let's do revenue growth. Let's go to 5, 8, and 11. Now you sit there and hear me pausing. The goal of stock analyzer tool isn't to be 100% spot on. It's to be conservative. And if the stock falls where you want it to fall, then you go do more research and see if your assumptions were correct. It's not to sit there and get it spot on day one. It's start from a high view and figure out if it's worth going forward. Profit margin. I'm going to go with 13, 15, and 17. Oh, wait a second. Look at that free cash flow. Maybe I'll go a little bit higher. And the reason being is these free cash flow and earnings numbers, profit margins should be equal over long periods of time. But I'm still going to go lower on the low side. And for free cash flow margin, I'm going to do 16, 19, and 22. PE, 14, 16, 18, 14, 16, 18, and a 12.5% return. Now, I did 14, 16, 18 again here Because even though PayPal has a lot of competition coming out there, they're still very trusted, and they have Venmo. And Venmo is crushing it right now. I love Venmo. When somebody says to me, hey, do you have Cash App? I laugh at them. I throw things at them, and I tell them they are just absolutely useless human beings. And then, of course, I tell them to download Venmo, and we'll go from there. Literally, I have people who do work for me around my house or whatever. Many of them. I can probably count to 10 who I said, do you have Venmo? No, I go download it. And now I see them on Venmo doing all these transactions just because I started with them. Then all of a sudden they're doing it. So hit the analyze button. The company's currently at 94. All right. Again, just like Google. Low side, high 40s, high side, 115 and 120, middle side, somewhere in the 70s. So again, add it to your watch list. I'm going to put it at 78 here for no other reason than I just want to be notified when it's done. That way I can get aggressive and start doing more and more research. eBay. Guys, eBay, the number one. I mean, what is another even auction place on the internet? And I'm sure somebody's going to say, hey, moron, auction, whatever. But eBay is a place to go for auctions. If I ask 100 people in a room, where would you sell something in an auction style on the internet? I'm going to guess that 80 or 90 are going to say eBay. Okay, so eBay is the place to go. Look at the stock. Let's go 5 years. It hit a high last year of $80, and then it hit a low of 41, and now it's at 47. So it's rebounded a little bit. Let's go to the 8 pillars. Oh, close to an 8-pillar thriller. Cash flow has decreased. So this is what I was talking about last time. Their 5-year PE is 6.87. Their 5-year price of free cash flow is 12.2. The PE being lower than the price of free cash flow tells me that there's more earnings being reported. So let's go check that out. Let's go see what happened here. Oh, this is why. Big fluke earnings right there. $11.6 billion. Income from discontinued operations. They had a $13.3 billion income from discontinued operations. We have to go research that. What was that? What did they do? What did they sell off or do something or discontinue and made that big gain? So that's what's affecting that number. Okay. So when we go to our stock analyzer tool, that profit margin, it's 113% last year. Why? Because they had the one-time gain. So you're going to ignore that completely. These two numbers are also factoring in that big gain. So we gotta go much lower here. Do you see what I just did here? I went and used the 8 pillars to ask a question to get an answer that affected how I'm going to look at my stock analyzer inputs. Please rewatch this video since we're doing so many companies so you can understand the stock analyzer tool more and more. So revenue growth. Now, the other thing I want to talk about revenue growth, as I already know, they sold off PayPal. They spun off PayPal. If you know, eBay used to own PayPal. They spun it off years ago. That's why the revenue has fallen so much. But I'm still going to be conservative. I'm going to go 4, 7, and 10%. Profit margin, I'm going to do 20, 24, and 28%. Free cash flow margin, I'm going to do... See, that's what I like about the free cash flow here. It's going to guide me on my profit margin more. So I'm going to do... Actually, I'm going to go back here for profit margin, do 18, 21, and 24%. Significantly lower, but I think it's about right where it should be. Now, PE, guys. Look at this PE. 2.4. No, that's way too low for a company like eBay. I'm actually going to go with, and it's also affected by the fact they had that big gain last year. 13, 15, 17, 13, 15, 17 on the price of free cash flow. And I'm going to do a 12.5% return. eBay's $47. Analyze button. Holy cow, look at this. A low of 40, a high of 95, middle range of 60. So again, if you like these middle and high assumptions, please do your research, join your community. It'll be worth the investment for you. Less than a cup of coffee per day. You can go talk to people about eBay and see what's going on with it and see if these assumptions are correct. Because these assumptions, if eBay can match these, yeah, eBay, you're going to get a 12.5% return at least by buying eBay today if you believe these assumptions and you're comfortable with the company. Now, remember, your job isn't to put all your money in eBay. I still believe in owning 20 to 40 companies that fit these parameters that work for you. I do not recommend having more than a few percentage points of every company in your portfolio because that's just too much risk. Go do your work and find 20 to 40 companies. Our final company, Alibaba. Now, Alibaba is getting hit hard because of delisting, the threat of delisting from Alibaba. Now, I have talked to Merrill Lynch, and Merrill Lynch has told me that if Alibaba gets delisted in the New York Stock Exchange, my shares would get converted to Hong Kong, and they'd just be held there. Charlie Munger has Alibaba. And I'm not saying just because Charlie Munger has Alibaba that you should buy it. But my opinion on Alibaba my original opinion was I didn't trust the numbers out of all companies coming out of China. But when I heard Munger had Alibaba, I said, okay, if he trusts China, I will trust China too. But I have no idea what Charlie Munger values Alibaba at. So let's go look at the 8 pillars here. All right, a little bit different here. We have a drop in net income and an increase in shares outstanding. So they're diluting owners just a smidge here. All right, not a ton, about 1% a year, but it's still diluting owners. But lower multiples of earnings. So let's go take a look further about this one. So let's go to Stock Analyzer tool. Now, revenue growth numbers. Their revenue last quarter, I think it might have actually decreased. It was their first ever year-over-year decrease in revenue. But I don't think that's going to be sustainable for the future. China's also the fastest growing economy, basically, with India, and the fastest growing middle class in the world. Alibaba is the #1 company in China. I think it's going to help them out a lot. So I'm still going to be conservative. I'm going to go 6, 9, and 12% profit margin. I'm going to go with 15, 18, and 21. Free cash flow margin. Oh, wow. Look at that free cash flow the last 5 years, 24.5%. So my profit margin might be low already, but I'm going to do the exact same thing. PE. I'm going to go with 14, 16, 18, 14, 16, 18 on price of free cash flow. And for this one, guys, maybe do 15% return. And the reason being, the higher desired return, the lower the price of the stock. And there are a lot of unknowns about the stock going to China, et cetera, going to Hong Kong. So I understand going with a higher desired return to give yourself more margin of safety. Hit the analyze button. The stock is currently at 91 bucks. All right, low side 90, high side 223, middle side 143. If you like this video, guys, please click the next video, which is explain the 8 pillars and a more thorough analysis of how we use our 8 pillar portfolios. And please subscribe to this channel. I appreciate your time.